What we have done in capital structure decision making, we are ultimately deciding what is the proportion of debt and equity in our total capital employed. So if my total capital employed is 10 lakhs, I'm just deciding what will be my equity proportion, what will be my debt proportion. This is nothing but capital structure decision. We have understood another concept, which is leverage effect or trading on equity effect. What is leverage or trading on equity is very simple. As you increases the debt proportion in your capital structure, your overall cost reduces, profitability increases, and your value of company, market price of the share will increase. This happens only if there is a favorable leverage. When there is a favorable leverage, when R is greater than KD, then there is a favorable leverage. Otherwise, this trading on equity will not work. If R is less than KD, then you should not increase the debt proportion. If R is equal to KD, you may or you may not increase the debt proportion. Then we started learning two concepts, which is financial break-even point and EBIT EPS indifference point. We have found out the answer. We have understood the formulas, how to find out the answer. But the real concept is yet pending. Let me take one example and I will again do financial break-even point and EBIT EPS indifference point. Say there is a company X Limited planning to borrow total 1 lakh rupees. Now you will say me, sir, in option 1 and 2, why it is 1 lakh? Because total capital employed remains same. In these two options, there is only one difference, that is capital structure. Option 1 says equity will be 40,000, debt will be 60,000. Option 2 says equity will be 20,000 and debt will be 80,000. What will be EBIT or what is EBIT? Not yet certain. Try to concentrate. First, they are asking us, what is the break-even point for X Limited? What is financial break-even point for X Limited? Now, if you give me two options, there will be two break-even points. There are two options. Both of the options are not having preference share, so it is good because we can easily find out financial break-even point. This debt are of 10%. Let me also write down tax rate. Tax rate is 30%. Now in option 1, if it is 30%, in option 2, it will be 30%. It is the same company with different capital structure options. We are finding out financial break-even point for both the options. Financial break-even point for both the options will be different. It will not be same. What is financial break-even point in option 1? What is the formula for financial break-even point? Interest plus preference dividend upon 1 minus T. Again, I am telling you, I am not against mugging up the formulas. But if you don't know how this formula is derived, then it is a sin. You should not mug up the formula without understanding it. Once you understand it, you can convert it into formula. You can always mug it up. Here, there is no preference dividend. So what is financial break-even point is interest. What is interest in option number 1? 60,000 into 10% is 6,000 rupees, which will be financial break-even point. And what will be financial break-even point in option number 2 is 8,000 rupees. What will be EBIT EPS indifference point? Please understand, you can find out something in difference only if there are two options. So there will be no two separate EBIT EPS indifference point. EBIT, EPS in difference point, you should be always having two options. You should be having two types of capital structure. Then only you can find out indifference point. What is indifference point? They both are same. What is actually indifference point? Level of EBIT at which EPS is equal. What is financial break-even point? It is level of EBIT at which EPS is zero. EBIT, EPS indifference point, level of EBIT at which EPS is equal. Let me find out in a separate page what will be EBIT, EPS indifference point. What will be EPS for plan number 1? I am assuming equity are of 100 rupees. So plan number 1, my EBIT is X minus interest is 60,000 into 1 minus T. I will be getting EAT. What is this? EBIT minus interest into 1 minus 0.30. This is EAT. There is no preference dividend. So EAT will be is equal to earnings available to equity shareholders divided by number of shares. Number of shares are 40,000 divided by 100, that is 400. Should be equal to X minus, it is not 60,000, it is 6,000. Interest is 6,000, not 60,000. X minus 8,000 into 1 minus 0.30. What is plan number 2? Equity shares will be 200. I have taken EBIT as X. This is my EPS of plan number 1. This is my EPS of plan number 2. I have equalized it because EBIT, EPS indifference point is a point where EPS under both plan is the same. Let me just solve it. This is 0.70. Divided by 2. So I can do this 0.35. This will be 0.35x minus 2,100 is equal to 0.7x minus 5,600. 0.35x coming on the side is 0.35x, 0.7x minus 0.35x, 5,600 minus 2,100, which is 3,500. What is X? 10,000 rupees. X if 10,000. What is X? What X we have assumed? X is nothing but EBIT. If my EBIT is 10,000, then EPS under both the plan will be equal. If my EBIT is 10,000, my EPS under both the plan will be equal. You can see previous lecture we have taken same figures. And when the EBIT was 10,000 R equal to KE, I have told you, whenever there is no preference shares, finding out EBIT, EPS indifference point is very easy. Why? When the answers will be equal, when the R is equal to KD. What is KD? 10%. So what should be R? 10%. When R, what is R? It is EBIT upon capital employed. If R is to be 10%, what should be EBIT upon total capital employed is 1 lakh. So EBIT should be 10,000 rupees. 1 lakh into 10%. But this can be used only if there is no preference dividend. Otherwise, this cannot be used. So EBIT EPS in difference point is 10,000 rupees. Sir, of plan 1 or plan 2? Between plan 1 and plan 2. It is not of only plan 1 or only plan 2. Between plan 1 and plan 2, EBIT EPS in difference point is 10,000. I want to also find out what is exactly EPS at 10,000. At 10,000, what is EPS? I know under both the plans it will be equal, right? Let me give you the situation even. So the situation, same. Situation number 1 and situation number 2 is exactly same. There is no change in it, right? Even I have taken tax rate as same. So what is earning after tax? 2,800, 1,400. What is EPS if the EBIT is 10,000? What is EPS? 7. What is EPS? 7. Under the situation number 1, plan 1, plan 2. I have taken same figures so that my calculation becomes easy. I know that now my EPS at this level is 7 rupees. Let me explain you the concept of a financial break-even point and the concept of EBIT EPS in difference point. Till now what we have learned is calculating it. What does it mean and calculating it. We are going to decision making. Which company is under consideration? X Limited. Try to concentrate. Company under consideration is X Limited. This company can earn EBIT of 0 rupees. This company can earn EBIT of infinite rupees. Company is considering two options. Option 1 capital structure and option 2 capital structure. We know what is option 1 capital structure? 40:60. What is option 2 capital structure? 20:80. What is capital structure decision? Ratio between equity and debt, or ratio between debt and equity is nothing but capital structure decision. I am telling you, still company has not taken any decision whether it will go for option 1 or option 2. Let me put everything on this timeline. Starting from 0 up till infinite. If EBIT is 6,000 rupees. What is the 6,000 rupees? So first I am writing 6,000. This is EBIT rupees 6,000. It is a financial break-even point of option 1, which is less risky as compared to option 2. Another one. What is financial break-even point for option 2? 8,000. Financial break-even point for option 2. Believe me, the plan which is more risky. How I came to know that plan 2 is more risky? Because higher is the debt. And one of the student in previous lecture told me that, sir, higher the debt, higher is the risk. So this plan is more risky as compared to this plan. Whenever the plan is more risky, there will be higher interest. Higher interest means higher financial break-even point. This is financial break-even point of option number 2 at EBIT of rupees 6,000. And third one is EBIT rupees 10,000. EBIT rupees 10,000. And it is EBIT EPS in difference point. It is EBIT EPS in difference point. That is EBIT rupees 10,000. Try to understand. I am a CEO of this X Limited. I am having this chart with me. And now I am forecasting what will be my EBIT in next year. What will be my operating income? If I forecast, if I feel, if I hired analyst and analysis says that my EBIT will be rupees 4,000. See what will happen. Whether I have gone for plan 1 or whether I have gone for plan 2, I would be earning EPS which is negative. Whether I have gone for plan 1, whether I have gone for plan 2, my EPS would be negative. Sir, why? It is below financial break-even point of plan 1 also. It is below financial break-even point of plan 2. So under both the plan, EPS will be negative. Still, I am not saying if my forecast is rupees 4,000, with which plan I should go. But this is my observation. Let us go to next one. Suppose if my economist, if my forecaster says that between this second one is 8,000, right? Yes, this is 8,000, green color, this is 8,000. If my forecaster says that my EBIT is going to become 7,000, had I selected plan 1, had I selected plan 2, can you tell me, if I had selected plan 1, whether my EPS will be positive or negative? Had I selected plan 1? All of you are there in the lecture?
Positive, sir.
Why positive?
It is below financial break-even point.
It is above financial break-even point.
Sorry, above.
Above financial break-even point, and so anything EBIT which is above financial break-even point, my EPS will be positive. Same student, had I gone for plan 2 capital structure, option 2 capital structure,
No, sir.
positive or negative?
Negative.
Negative. EPS would have remained negative. So if your forecaster, if your economist says that your operating income is going to become 7,000 in next year, you should better go for plan 1 and not plan 2. And believe me, plan 1 will be less risky. This is less risky, as comparatively this is more risky. That we have already decided, right? So if you are not capable enough of taking the risk, if you are having unfavorable leverage, find it out. Your R will be less than KD in this case. Then only there is an unfavorable leverage, and then only the plan selected will be an non-risky plan. Otherwise, you will always select a risky plan. So here, I am also taking a decision, right? If it is forecasted that you are going to earn an operating income EBIT of rupees 7,000, you should go for plan 1, which is less risky. Alright, because in plan 1 EPS is positive, in plan 2 EPS is negative. So here the decision making is very simple. Alright, I am going to third option, which is this. If my forecaster, if my analyst says that my EBIT is going to be 9,000 rupees, If I had selected plan 1 or if I have selected plan 2, this is our option. All of you should understand it. Either I will be selecting capital structure 1 or I will be selecting capital structure number 2 plan. Yes, Jainesh, same person. I want whether EPS will be negative or positive in both the plans.
Positive, sir.
In both the plans?
Yes, sir.
Yes, because it is about this also, it is about this also. It is about both financial break-even point, and so it will be EPS positive. Here also EPS will be positive. Next and last one. If my EBIT forecasted is 20,000, my analyst says that your forecasting of your EBIT will be 20,000 rupees. Then, Jainesh, plan 1, plan 2. I want just answer whether EPS will be positive or negative.
Positive, sir.
Because again it is greater than financial break-even point. So, financial break-even point up till this point of time should be absolutely easy. If your EBIT is below financial break-even point, your EPS will be negative. If your EBIT is above financial break-even point, under any plan, you will be having positive EPS. If your EBIT is exactly equal to financial break-even point, your EPS will be 0. That is the meaning of financial break-even point. So understand how it is useful in decision making. Suppose my economist says that your EBIT is going to become 18,000. I am very happy because I at least know that my EPS will be positive. Whether it is good decision, bad decision, under both the scenario, whether I select plan 1 or plan 2, it will be nothing but a positive EPS. But what is the use of EBIT EPS indifference point? What is the use of EBIT EPS indifference point that we are going to learn? Try to concentrate. I am drawing another line. Which color I should choose? Yes. I'm choosing black itself. If my EBIT is between this, of course, up till this. What is this area? If my EBIT is less than, if my forecasted EBIT is less than EBIT EPS indifference point, IDP, then what? Please understand, I have hired a forecaster. He says me that your expected EBIT in next year is 9,000 rupees. It is below EBIT EPS indifference point. Very simple answer. I will go for plan 1, which is less risky. If my EBIT EPS indifference point is 10,000, if the forecast is that my EBIT is going to be 9,000, I should directly select the plan which is less riskier, which is plan number 1. And if my forecasted EBIT in next year, my EBIT is going to be, say, this. Anywhere over here, say it is 15,000. Without seeing anything, my forecasted EBIT is greater than EBIT EPS indifference point. I should select plan number 2, which is more risky. See, I will not have to do all the calculations. If I am having two answers, a financial break-even point, EBIT, EPS indifference point, I will just have to ask my analyst what is the expected EBIT next year. If he says me above 10,000, I will go for plan 2, option number 2. If he says me less than 10,000, I will go for option number 1. I will not have to do that long calculation. Sir, prove us that if it is less than 10,000, we should go for plan 1. This is the use of EBIT, EPS indifference point. Less than that, you should go for less risky plan. More than that, EBIT forecasted, you should go for more risky plan. And we have already proved it. Try to concentrate. I have taken same example. Say this. First and second plan. Situation number 1 and situation number 2. If your EBIT is 8,000, which is less than EBIT EPS indifference point, I should go for plan 1. See, what is EPS in situation number 1? 3.5. What is EPS in situation number 2? 0. Situation number 2 will be 0 because it is 8,000, right? So anything less than 10,000, I should always go for situation number 1. Sir, prove it. If my EBIT is 9,000, I can easily do it. See, if my EBIT is 9,000, see the answer, what changes? It should be 9,000. What is EPS in option number 1? 5.25. What is EPS in option number 2? 3.5. Still option number 1 is good. Let me take in 9,999. 9999. See the difference. Still option number 1 will be better. Up till 10,000, option number 1 will be better. Sir, at 10,000, it does not make any difference. At 10,000, the EPS is going to remain 7. Sir, above 10,000, say at 15,000, believe me, option number 2 will be having higher EPS. This is EPS. Then option number 1. Which plan is better? Plan number 2 is better. That will be our answer if my EBIT is greater than 10,000. Sir, what is the use of EBIT EPS indifference point? Suppose between option 1 and option 2, we have found out EBIT EPS indifference point. At this level of EBIT, the EPS will be same. Below this, less risky plan will work. Work means it will be beneficial for the company. Above this, more risky plan will work. Alright, more risky is having more debt, less risky is having less debt. Sir, what about this decision? If your expected EBIT is less than 6,000, what decision you should take? You should plan to close down. I am not saying you should close down. You should plan. You should go to marginal costing. You should find out shutdown point. If your thing is less than shutdown point, then you should plan to, because you are going to have negative EPS, whatever is the plan. If this is the situation, we have already taken decision plan 1. If this is the situation, we have not taken the decision. We have written plan 1 will be having positive EPS, plan 2 will be having positive EPS, but 9,000 is less than EBIT EPS indifference point, and so it comes under this, and so I should go for less risky plan, which is plan number 1. In this also I have not taken any decision, but I'll take it now. If my EBIT expected is 20,000, it is greater than EBIT EPS indifference point, I should go for more risky plan, which is plan 2. All right. Above 6,000 in option 1, I will be having positive EPS. Above 8,000 in option 2, I will be having positive EPS. Less than 10,000, I should take less risk. Believe me, at this level, EBIT EPS indifference point, R will be equal to KD. In this scenario, this black color scenario, R will be less than KD. And in this pink color scenario, R will be greater than KD. So here there will be favorable leverage. Here there will be unfavorable leverage. And this is how the concept of a financial break-even point and EBIT EPS indifference point works. Let us go to concept of capital structure theories. Please understand, capital structure theories are theories given by some experts to take a capital structure decision. What is capital structure decision? Deciding between debt and equity. The proportion of debt and equity is capital structure decision. And these theories are given by some of the experts who says this is how you should be taking capital structure decision. Let me first explain you some of the new formulas, some of the new ways of finding out KE, KD, value of the firm, etc. Let me take one example of XYZ Limited. EBIT was rupees 1 lakh. Interest was 20,000 in form of 2 lakh rupees debenture of 10%. And so EBT was 80,000 and taxes were 0. I am assuming no taxes. So EAT was also 80,000. There was no preference dividend, so this is also earnings available to equity shareholders. This is nothing but earnings available to equity shareholders. All right. The KE is already given. What is the required rate of return of equity shareholders? Say how the company has found out by CAPM model. But the company has already found out that the KE is 12%. We are finding out value of equity, value of debt and value of firm by slightly different formulas. We'll be also finding out overall cost of capital, that is KO. We are merging with the concept of cost of capital, but it is all right. Concentrate. I can write down KE is equal to P0 even earnings approach without growth. Earnings approach without growth. If I multiply N in numerator as well as denominator, I can do this. This will be total earnings divided by P0, price of one share, multiplied by number of shares, is nothing but total value of equity. That is market price of all equity. is nothing but KE. In other words, I can write down value of equity or total value of equity is equal to earnings. And which are these earnings? When you find out even, it is EPS. So it is earnings available to equity shareholders divided by, this K is going this side, divided by K. So if I want to find out value of equity, I can find it out by this manner: earnings available to equity shareholders divided by KE. Hence, I am writing my first formula. I can find out value of equity in this manner also. Market value of all the equity shares I can find out by this method also, which is earnings available to equity shareholders divided by KE. I am doing it in this question. Value of equity is equal to earnings available to equity shareholders divided by KE, which is 80,000 divided by 12%. And my answer will be 6,66,667. Right? Let me find out value of debt. Now, market value of debt and book value of debt are always same. What is book value of debt? We already know it is 2 lakh rupees at 10% rate of interest. So our interest is 20,000. So value of debt is rupees 2 lakhs. Sir, can I find out by formula? Yes, it is nothing but interest divided by KD. What is interest? 20,000 divided by KD, 10%. It is interest divided by KD. This is nothing but value of debt. Value of debt is interest divided by KD, which answer is 2 lakhs rupees. Now, if you think that the owner of the companies are equity shareholders and debenture holders, all the persons who are providing you finance are, say, owners. What is the total value of the company? We never speak company in finance. So what will be total value of firm? It is nothing but value of equity plus value of debt. Value of equity plus value of debt is equal to value of the firm. All assets, see, this is my balance sheet. Balance sheet is always tallied. Whether you value all assets minus all liability, or you value only equity plus debt, the answer is going to remain same. To value a company, you have learned amalgamation. It is net asset method, value of all assets minus value of all liability. In other case, you can even value your equity shares and decide that what is the value of the company. In this case, total value of the firm is equal to value of equity plus value of debt. So can I write down? Value of firm will be is equal to 8,66,667. This is total value of the firm. Try to understand. I am summarizing some of the formulas. Value of equity is equal to earnings available to equity shareholders divided by KE, or KE is equal to total earnings divided by value of equity. It is the same formula that we have learned in cost of capital. There is no separate formula. Second one, value of debt is interest divided by KD. Now try to understand, I'm writing it on separate page for a specific reason. How to find out value of equity? In numerator we take earnings, In denominator, we take cost or required rate of return. This is how we value anything in finance. In first lecture, I told you, valuation of anything in finance. I am valuing equity. In numerator, you take a cash flow of first year. I have assumed earnings divided by rate of return. And what is the rate of return for equity is nothing but KE. It is required rate of return of equity shareholders. How to value debt? In numerator, you take cash flow of first year, which will be interest. In denominator, you take rate of return, which is nothing but KD. Because you are valuing debentures, the denominator should be KD. All right. Or KD is also equal to interest divided by value of debt. And this formula also we have learned in cost of capital. I divided by B, cost of irredeemable debentures. We have done this. I divided by B. I is nothing but interest. B is nothing but market value of the share, which you, if you borrow money, you will be getting that much money. And number 3, value of a firm can also directly be found out. How? In a numerator, you take total earnings. And what is total earnings? EBIT. EBIT is available to debenture holders also, and it is available to equity shareholders also. So when you are talking about a firm, you should be taking earnings which is available to equity shareholders as well as debenture holders, which is EBIT, divided by KO. Or in other words, you can also find out KO is equal to EBIT upon value of a firm. Same thing. Value of firm is equal to EBIT upon KO, or KO is equal to EBIT upon value of firm. We have also learned value of firm is value of equity plus value of debt. Alright. Try to understand this. I can find out KO in my example. What is EBIT in my case? 1 lakh. What is value of firm? 8,66,667. Multiplied by 100, I'll get answer of KO. That is overall cost of capital. 1 lakh divided by 8,66,667 multiplied by 100, which is 11.538 approximately. 11.538%. What is this overall cost of capital? I was already knowing KE. This is KO, which is 11.538. And so this formula where KO is EBIT upon value of firm. You'll say me, sir, we are in the chapter of capital structure. We have already learned KO in cost of capital. It is weighted average cost of capital. Don't give us new formula. We already know formula for KO. It is sigma IW divided by sigma W. What you take as I, what you take as W? You take I as a cost of equity and debt, and W as a weight. Right? What is I? Cost of equity? It is already given, 12%. What is cost of debt? 10%. There are no taxes. So before tax, after tax will not work. What is weight of equity? We know value of equity. We have found out 6,66,667. What is value of debt? 2 lakh rupees. What is sigma W? 8,66,667. What is the sigma IW? 6,66,667 multiplied by 12% is 80,000, and this is 20,000. This is 1 lakh, In cost of capital, I have told you KO is sigma IW divided by sigma W, which is 1 lakh divided by 8,66,667, which will be nothing but 11.538. I am not teaching you something new. We have already learned it in cost of capital. But please understand this formulas, especially this, you should use whenever there are no taxes. If there are taxes, good formula to use is this, sigma IW divided by sigma W. So, as far as these three things are concerned, we should be absolutely clear. How to find out value of equity? Earnings available to equity shareholders divided by KE. This is how we value anything. Value of debt, income from debt divided by KD. Value of firm, income to debt and equity divided by KO. I will be getting value of the firm. Alright. Again, KE, KD and KO can be found out by the same formula, just changing the side. Also KO by cost of capital method, that is sigma IW divided by sigma W, and by this method is going to remain same. So there is nothing new what we are learning. Try to concentrate. Now we are ready to learn some capital structure theories. Let us learn some capital structure theories. As I told you, these are the theories given by some experts, that if you use this formula, this theories, then you will be taking a sound optimal capital structure decision. First is net income approach. See what does net income approach says. As you increase debt proportion in capital structure, your overall cost, which is KO, will reduce, and value of a firm will increase. This is what a net income approach says. Have you heard this somewhere? What is this? As you increase the debt proportion in your capital structure, your overall cost will decrease and value of firm will increase. Anywhere where you have heard in previous lecture, especially? No one?
Trading over equity.
Exactly. This is the same as a trading on equity. Net income approach says the same thing as a trading on equity or leverage effect. Correct. It is a trading on equity or leverage effect. Let me take one simple example of net income approach. There is XYZ Limited having EBIT of 15,000 rupees, having interest 1 lakh were debentures, and let me also write down capital structure. 9 lakh rupees was equity and 1 lakh rupees was debt at the rate of 10%. Let me draft the question properly. What is given and what is to be said. This is XYZ Limited. Equity is 1 lakh rupees. Debt is 9 lakh rupees. Debt is of 10%. KE is 15%. and EBIT is rupees 1,60,000. I am finding out answers of EPS or the various answers. EBIT is 1,60,000 minus interest will be 90,000. This will be 70,000. This is earning after tax because I am assuming tax is 0. EAT is 70,000 or it is earnings available to equity shareholders. I can easily find out value of equity. By which formula? Earnings available to equity shareholders divided by KE, 15%. What will be value of equity? 70,000 divided by 15% is 4,66,667. What is value of debt? Is already there, 9 lakh rupees or 90,000 divided by 10%. The total value of a firm is the 13,66,667. What will be KO? KO is nothing but EBIT divided by value of firm. 1,60,000 divided by value of firm is 13,66,667. Multiplied by 100, of course. 1,60,000 divided by 13,66,667, which is 11.70. Right. Now try to understand the situation. For the same company, if I increase the capital, no. If I increase the debt proportion for same company, if I increase the debt, no. If I increase the debt proportion, so what I am trying to do, I will reduce the equity, I will increase the debt. I will reduce the equity, I will increase the debt. So let me say my equity is 50,000 and my debt is 9,50,000. Still I will be borrowing 10 lakhs rupees only. My EBIT is going to remain 1,60,000. I am doing same manufacturing of pen business. I have borrowed same 10 lakhs rupees. My operating income is going to remain same. Operating income does not change with capital structure, but my interest will change because it will become 95,000. And my EAT or earnings available to equity shareholders will also change, which will become 65,000. Now it is less. First it was 70,000. But believe me, still the answers will be favorable. Value of equity. What will be value of equity? 65,000 divided by 15%. Value of equity will also change. ₹4,33,333. What is the value of debt? We need not find out because we are directly having it. 9,50,000 rupees. What will be total answer? 13,83,333 is nothing but value of. Agreed? What will be KO? KO is EBIT 1,60,000 divided by value of firm 13,83,333. 1,60,000 divided by 13,83,333, which is 11.56%. Hence this concept. See, if someone asks you what is net income approach, this is net income approach, right? As you increase the debt proportion in your capital structure, as you increase debt proportion in your capital structure, your overall cost KO will reduce. KO was 11.70. If you increase the capital structure, overall KO will become 11.56. And it is very obvious. If you use a cheaper thing, debt is cheaper than equity. We already know KE is greater than KD. So whenever you are using cheaper thing more, ultimately it will reduce your overall cost. So KO is reduced and value of a firm will increase. See the value of firm. Here it is 13,66,000. Here it is 13,83,000 something. So this is the net income approach. Sir, we have done the same thing by finding out EPS and MPS, and we proved that if R is greater than KD, if we increase the debt proportion in the capital structure, the value of firm will increase, the cost will decrease. It is the same thing. There is no difference between net income approach and trading on equity. They are absolutely same. Sir, this will happen only if R is greater than KD. Believe me, the answer is yes. Even net income approach will work only if the R is greater than KD. So it is better to learn trading on equity rather than net income approach. But net income approach says the same thing what is said by trading on equity. Let us go to second one. It is net operating income approach. I am taking same example of XYZ Limited. EBIT is 1,60,000. This is current situation. Interest is 90,000. And earning after tax, because tax is 0, this is 70,000. I have taken the same situation. What net operating income approach says, try to understand. Net operating income approach says that as you increase the debt proportion in your capital structure, the things are going to change. Why? EBIT will be 1,60,000 and interest is going to become 95,000. So this will not be 70,000, this will be 65,000 EAT or earnings available to equity shareholders. If you increase the debt proportion in your capital structure, what does net operating income approach says and which is logical? Try to understand. Net income approach calculates everything, but it ignores a risk. Risk is absolutely ignored over here. If you increase the debt proportion in the capital structure, your risk will always increase. The risk of the company will increase, or in other words, the company will become more riskier. If the company is becoming more riskier, net operating income approach says that value of a firm, let me just take it from previous answer, 13,66,667. This is value of firm. What was value of equity? I have taken same example, so I can copy it down from here. 4,66,667. And what is value of debt is 9 lakh rupees. What was KE in this case? 15%. And what was KO in this case? Was 11.70. Try to understand, even if I have taken same figure, same example, These two approaches are totally different. Even if the name is also matching, net income and net operating income. Net operating income is totally opposite. Try to understand what net operating income approach says. If you increase the debt proportion in capital structure, your cost will reduce. Agreed. Why? Debt is less costlier than equity. But your risk will increase. Why? Debt is more riskier than equity. So your risk increases. And for more risky company, the required rate of return for equity shareholders is higher. And so your KE will also increase. See, on one hand, your cost is decreasing. On another hand, your cost is increasing, and it will compensate each other. And your KO will remain same. And hence, your value of a firm will remain same. Why it is logical? Let me first calculate it and then find out the answer. Here, we have assumed that KE is 15% over here also and 15% over here also. In net operating income approach, we cannot do it. Try to understand. It says that your value of firm will remain same, 13,66,667. This is what approach says. I'll explain you why it is even logical. Your value of debt is fixed in case number 2, which is 9,50,000. What will be then value of equity? Is difference between this 13,66,667 minus 9,50,000. Four lakh 16,667 is a balancing figure, which is value of equity. Then what will be cost of equity? Will be 15%. No. What is cost of equity? We can find out by earnings available to equity shareholders divided by value of equity. Earnings available to equity shareholders is 65,000 divided by 4,16,667, which is 65,000 divided by 4,16,667, which is 15.60. What will be my KO? Believe me, it is EBIT divided by value of firm, and so it will remain 11.70. You can even verify 1,60,000 divided by 13,66,667. So it will be 11.70. What is happening? Try to understand. Sir, the calculations are same, formulas are same, agreed. But the concept is totally different. See, I have seen students saying, sir, net operating income and net income approaches are same. They are not same. They are exactly opposite. What does net operating income approach says? As you increase the debt proportion in your capital structure, your cost should reduce because debt is less. What is the reason why your cost should reduce? Because KE is always greater than KD and you are increasing that proportion. But your risk will also increase. And as your risk increases, the required rate of return of equity shareholder will increase because you have increased the risk. See how CAPM works? Beta. Beta is the measurement of risk. Higher the beta, higher will be the answer. Higher the risk, higher will be required by equity shareholders. How we find out required rate of return of equity shareholders? Risk-free rate of return plus risk premium. So if risk increases, the required rate of return of equity shareholders increases and KE will increase. See, it is also visible in our calculation. First required rate of return of equity shareholder was 15%. Now required rate of return of equity shareholders is 15.60%. As the risk has increased, we will have to increase our cost of equity, and KE is 15.6. So cost will increase. Why? Because KE has increased. And this decrease in cost and increase in cost will compensate each other, and value of firm will remain same, and KO will remain same. What will only increase is KE, and this is the net operating income approach. What does it mean? It is net operating income approach. It is irrelevance approach. What does it mean? It says capital structure decision. Try to understand what the approach is trying to say. Is irrelevant for any business making. You increase the debt, your cost will decrease, your risk will increase, your cost will increase, it will compensate each other. Whatever is the proportion of debt and equity, your value of firm is going to remain same. Are you getting it? Your value of a firm is going to remain same, whatever is the proportion of debt and equity. So it is irrelevance approach. Try to understand a theory of capital structure saying that capital structure chapter is not important. Capital structures are irrelevant for decision making, and this is what net operating income approach says. As you increase the debt proportion in your capital structure, your cost should reduce. But on other hand, your risk is increasing, your K is increasing, so your cost is also increasing. The reduction in cost will be balanced with increase in cost. The value of firm KO will remain same. Just the thing, your KE will increase because your risk has increased. This is net operating income approach. And if you have understood the approach, try to understand. People say me, some of the students say me, sir, net income approach and net operating income approaches are same because the formulas used are same. No, formula used are general financial formulas for valuation. The approaches are totally different. Net income approach is a relevance approach. Net operating income approach is the irrelevance approach. It is irrelevant. Capital structure decisions are not relevant for business decision making. This is what not net operating income approach says. So we have done two approaches: net income approach, net operating income approach. Let me also teach you one traditional approach, which is a more or less a theoretical point. See what does it says. Up to a level, which level not defined. If you increase debt proportion, then your value of firm will increase, KO will decrease. So basically it says a net income approach will work. I should draw like this. Up to a level, if you increase the debt proportion, value of firm will increase, KO will decrease. After that level, if you increase the debt proportion, your risk will also increase, KE will increase, so value of firm will then remain stable or constant. then value of firm will not increase. So my debt is 2 lakh. I am taking a debt of 2 lakh 20,000. Then net income approach will work. My value of firm will increase. But instead of debt of 2 lakh, now I am raising 3 lakhs rupees more and debt is 5 lakhs. Then net operating income approach will work and value of firm will not change. This is what is said in traditional approach. So it just says up to a point of time your net income approach will work. Afterwards it will not work. This is traditional approach. Fourth one. It is Modigliani Miller approach. Let us start with the concept of Modigliani Miller approach. Try to understand. Again, he says the irrelevance approach. He says capital structure decisions are not important for decision making. If you increase the debt proportion in your capital structure, your risk will increase and so the value of firm remains the same. The difficult part in Modigliani Miller is this. It is arbitrage, which Modigliani Miller explains. This arbitrage is given in your module. This arbitrage is given in your books, but it is never asked in examination. But to understand Modigliani Miller irrelevance approach, ultimately you need to understand this concept of arbitrage in Modigliani Miller approach. Try to concentrate. I am taking a risky firm. Whose EBIT is say 10,000, interest is 6,000, and so earning after tax is 4,000. In basic theory of MM assumes there are no taxes. So theory can be proved only if you take no taxes. So earnings available to equity shareholders or EAT is 4,000. KE is a 15%. KE is 15%. And this is a 60,000 debt of 10%. Value of equity is earnings available to equity shareholders divided by KE, which is 4,000, divided by 15%. It is 26,667. Value of debt is 60,000, and so value of firm is 86,667. Say this is firm A, risky firm A. Let us go to another firm which is non-risky firm B. Where EBIT is the same. We can compare always to similar type of question, so similar type of firms. Otherwise there is no use of understanding capital structure. If a firm B EBIT we take 1 lakh rupees, it will be having higher value. Whatever is the capital structure, it will be having a higher value. Its interest is 0. All of you understand when I say non-risky firm? The debt proportion is 0. There is no debt in it. So earnings available to equity shareholders, because there are no taxes, is 10,000. KE is still 15%. Value of equity is 10,000 divided by 15%, which is 66,667. value of debt is 0, and so value of a firm is 66,667. And you can see on the board, value of a levered firm, value of a risky firm. Risky firm is also termed as a levered firm. Levered firm. Non-risky firm is also termed as unlevered firm. Levered is risk. Unrisky, non-risky is unlevered. Levered is risk. So risky firm is a levered firm. Levered firm value is higher than unlevered firm. Similar type of firm, just the capital structure is different. See the EBIT in both the cases are 10,000. Just the capital structure is different. Still the levered firm is having a higher market value as compared to unlevered firm. The value of the firm which is levered firm is higher than value of firm which is unlevered firm. Sir, then this is a relevance approach. No. Till the time we have done calculation of net income approach. This is net income approach that we have learned. Try to understand what does MM says. He says, if I am an equity shareholder of this firm, levered firm, say I am having 10% equity of this levered firm. I am 10% owner of this firm. Then what will be my current earnings? What are my total earnings? What is the total earnings of the company? 4,000. How much owner I am? 10%. So rupees 400 is my current earning. Good. I am 10% owner of this company. I am having 10% equity. But MM says, if this person sells all 10% equity, how much money he will get? This is total value of equity. Now he does not get 4,000 into 10%. That is profit. When you sell your shares, you don't get percentage profit. You get percentage of market value. So your value of equity is 26,667. And so that person will be getting 2667 rupees. And he will borrow a loan of 6,000 rupees from the market at the rate of 10%. So what he has done, say let us also name him Jainesh. This person was Mr. Jainesh, Mr. J. What he has done, he was holding 10% equity share in firm A. He has sold all his shares, got 2,667 rupees, borrowed 6,000 rupees more from the market, and ultimately now he is having 8,000 rupees in his hand. Taking this 8,000 rupees, he goes to firm number B. He sells everything in firm number A and goes to firm number B. If he wants to purchase this full company, if he wants to become 100% shareholder, he needs 66,667 rupees, right? How much money he is having? 8,667. How much money he is having? 8,667. Then how much percentage owner he will become in firm number B? In firm number B, he will become owner of this cross multiplication. It is 8. 8667 multiplied by 100 divided by 66,667, which is the 13% approximately of equity. Sir, this is good. Why? In firm A, he was only 10% owner. In firm B, he is 13% owner. This is not good. Understand? If you are owner of 1% in Reliance, and say if you are owner of 50% in Jai Limited, owner of 1% in Reliance is better than owner of 50% in Jai Limited. So just by seeing this percentage, you cannot say that his decision of selling all the things in firm A and going to firm B is correct. But let us understand now what would be his earning. What is earnings available to equity shareholders in this company? 10,000. How much percentage owner he is? 13%. So he will be earning 1,300 rupees. Right? But in this case, he has taken a personal loan of 6,000 rupees at the rate of 10%. Then he will have to pay that interest on loan, which is 600. What will be his net earnings is 700. Still, it is better than this earnings. It is better than what he was earning in risky firm A. What a person should do if he is having equity shares of a risky firm, he should go to sell all the shares in risky firm, go to non-risky firm. Modi Giuliani Miller says he will be benefited and he proves it. You just see the numbers. This is rupees 400, this is 700. You will say, sir, risk has changed. It has not changed, believe me. He was 10% owner of this company. So practically everything 10% belongs to Mr. J. How much risk this company was having? 60,000. What is the proportionate risk to A? You cannot do it that if 60,000 is the risk of the company, then 6,000 is risk of mine. But you are 10% owner. Let us assume you are taking 10% risk. Then you are taking practically risk of 6,000 rupees at 10%, which you are taking in this case also. How? This company is non-risky, but you are having your own risk. You have created your own risk. So previously, what was your risk? 6,000 into 10%. Currently, what is your risk is 6,000 into 10%. So your risk is same. Previously also, currently also. Previous earnings was 400, current earning is 700. Says you should go from firm A to firm B and see what he explains. Firm A valued higher, risky firm. Firm B valued lower, non-risky firm. And what he has proved? That you should go from this firm to this firm. Demand, now it is economics and not finance. Demand of this company will decrease. Demand of this company will increase. If all the persons are rational, this is one of the assumption of Modi Giuliani Miller, that all investors are rational and can understand this. See, many a times, even a commerce student who is learning CA intermediate does not understand this. So it is not a very correct assumption to understand that all the investor will understand this. If all the investors are rational, all of them understands this, people will sell the shares and will purchase the shares. So demand of the share will decrease, demand of the share will increase. Any shares whose demand decrease, the price will fall. here the price will rise because the demand has increased. And it says ultimately the value of firm, here the value is decreasing, here the value is increasing, value of a firm will become same. And after that, this will not work. This arbitrage will not work. Once the value of firm is higher over here and lower over here, this will work. But once it becomes the same, so what he is actually saying, these two figures will become same. He is not saying it will become 86,667. He is saying this will decrease and this will increase. He has not termed exact where it will become same. But let us assume at 70,000 rupees, value of firm becomes 70,000. Value of this firm also becomes 70,000. At 70,000 rupees, this will stop. Now it will not be benefited going from left to right or going from firm A to firm B. And the valuation will end over here. It will ultimately become same. So it does not matter whether you are having higher debt or whether you are having lower debt. Ultimately, and he says this will happen in seconds. This will not happen in 5, 10, 15 days. This will happen in seconds. Wherever people find out the opportunity to earn profit without any risk, earning profit without any risk is arbitrage. People will always do it, will do it in seconds, and in seconds, the value of firm will become same. So whether you are a risky company, whether you are having a higher debt proportion, or you are having lower debt proportion, it does not matter because value of higher debt and lower debt firm is always going to remain same. And so MM is which approach? Irrelevance approach. He says that it does not matter whether you increase the debt, increase your risk, or decrease the debt and decrease your risk, the value of the firm is going to remain same. He combines finance as well as economics to explain this arbitrage process. This is what Modigliani Miller says. Try to understand. So MM and NOI, Modigliani Miller, and net operating income says one and the same thing. MM and net operating income approach says the same thing, that capital structure decisions are irrelevant for decision making. Capital structure decisions are irrelevant for decision making. Let us understand two companies and let us go and learn even some formulas for MM. These are the formulas which MM has given, MM has derived. Try to take one example, A Limited and B Limited. A Limited EBIT is 18 lakhs rupees, and as we are doing the chapter of capital structure, B Limited, this both our companies are same except capital structure. Interest is 0. Interest is the 6,40,000. Can I say this is unlevered company? This is levered company. What is levered? Risky. What is unlevered? Non-risky. And here risk is that. And in A Limited, the risk is 0. Right? This is earnings available to equity shareholders or EAT, which is 18 lakhs. This is 11,52,000. Let me find out value of unlevered firm. Assuming KO is 18%. KO is 18%. What will be value of firm? See, if you are assuming irrelevance approach, you will have to take KO as the same in both the cases. Whether a firm is a levered firm, risky or non-risky, whether you are having 10,000 debt, 20,000 debt, your KO will remain same. Then only irrelevance approach will be proved. So value of firm will be 18 lakh divided by 18% will be 1 crore. Is 100 lakhs. What is value of equity? Sorry, what is value of debt? Zero. Value of equity is 1 crore. Because there is no debt, value of firm is nothing but value of equity. But value of firm is 1 crore. What is KE in this case? Will be 18%. Because there is no KD, so KE will be is equal to KO. Whatever is KO is nothing but KE. This is of unlevered firm. Let us go to levered firm. Believe me, KO will remain 18%. Value of a firm is going to remain same. Value of a firm is going to remain same. What will be value of firm? 100 lakhs rupees. Value of debt. Now interest are at the rate of 12%. So let me find out value of debt, which is 6,48,000 divided by 12%, which is 54 lakhs. These are 54 lakh rupees debentures at the rate of 12%. So value of debt is 54 lakhs and value of equity is nothing but 66 lakhs. What will be KE? KE is nothing but earnings available to equity shareholders 11 lakh 52,000 divided by value of equity, which is 66 lakhs. KE will increase 11 lakh 52,000 divided by 66 lakhs, which is 17.45. Value of equity is 46 lakhs. Thank you. Value of equity is 46 lakhs. Why I was confused? Because KE was decreasing. KE should increase. This is net operating income approach calculation which I am doing. right? Why I am doing it in mm, I'll tell you. 11,52,000 divided by 46 lakhs, which is a 25.0 approximately. See, net operating income approach. As you increase the debt proportion in your capital structure, your cost should reduce, but the risk will increase, so KE will increase. And your overall cost will remain same. And so your value of firm will remain same. Sir, this is net operating income approach. Try to understand, MM has given two formulas which says, now as I told you, MM and net operating income approaches are same. We can use this. But MM has given a formula. If there are no taxes, first understand. Number one, value of levered firm will be is equal to value of unlevered firm. Value of levered firm will be is equal to value of unlevered firm. This we have taken in the question, so we know it. Value of levered firm and unlevered firm is 1 crore rupees. Also, KE of a levered firm can be found out by KO plus debt upon equity, because in levered firm, say there is no need to find out KE in unlevered firm because it will be same as KO. So this formula is of KE of levered firm or risky firm. Debt upon equity upon KO minus KD. What is KD? It is nothing but cost of debt. Try to understand. What is KO? It is 18%. Whether it is levered or unlevered, it is 18%. Plus, what is debt? 54 lakh. Divided by equity, 46 lakh. Upon KO, 18% minus what is KD is 12%. This is 18% plus 54 divided by 46 multiplied by 6, which is a 7.04%. The total is the 25.04%, which was nothing but KE in this calculation also. So we have derived how to find out KE. We know, right? MM and net operating income both says that if you are levered as compared to unlevered, your KE will increase, but exactly how much? This much. KE will become 25.04. How you can find out? Directly by this formula. What is the proof of this formula? This. Here we have not used the formula. We have directly found out KE by our normal method. Then this is a correct formula which you can use for MM. KE is levered. KE of levered firm is equal to KO. This KO is nothing but KE of unlevered firm also. Agreed? Yes, because KE of unlevered is same as KO of unlevered, and KO of unlevered is same as KO of levered. So this can be termed even as KE of unlevered firm. So KE of levered is equal to KO or KE of unlevered plus debt upon equity into bracket KO minus KD. You can directly find out KE by Modi-Giuliani-Miller method. MM. If there are taxes. Now please understand, this is modified MM. Why? has already said that he has assumed there are no taxes, right? So if there are taxes, number one, value of levered firm will be higher than value of unlevered firm. So the basic approach has changed. If the taxes comes into picture, because it is not it is modified right? What does says? Capital structure are irrelevant for business decision making, but assumes no taxes. So if there are taxes, sir, here the value was equal, but here there were no taxes. If there are taxes, then value of levered firm is greater than value of unlevered firm. And how much? Value of levered firm will be is equal to value of unlevered firm, and because there are taxes, there will be tax benefit in interest and everything, and it will be exactly that multiplied by tax rate, or in short I can write down T. Let me write down full tax rate. So if your debt is, in this case the debt is say 54 lakhs, then 54 lakhs multiplied by tax rate, in that example we have taken tax 0, but multiplied by tax rate is nothing but value of levered firm. So you can see the equation and understand that value of levered firm will be higher. Value of unlevered firm plus debt proportion into tax rate, let me write down in this manner, into tax rate will be nothing but value of levered firm, right? And KE of levered firm, KE of unlevered firm will be same as KO, whether there are taxes or not. KE of levered firm will be nothing but KO, or KE of unlevered, which will be nothing but KO, plus debt upon equity into bracket KO minus KD. This remains the same. It does not change. It is same as whether there are taxes or whether there are no taxes. It does not matter. And these are the two formulas given by how to find out value of levered firm, how to find out KE. So you can just mug up this, right? Why? Because if taxes are 0, then this will become 0, and your value of levered firm will be is equal to value of unlevered firm, and KE formula is remaining same whether it is levered firm or unlevered firm. Sir, how to prove that KE will remain same even if there are taxes? Even if there are taxes, how to prove that this answer will remain same? Let me take this levered firm with the taxes, which is levered firm B Limited, and say taxes are 40%. B Limited with the taxes. What is EBIT? EBIT was taken as 18 lakhs minus interest, which was taken at 6,48,000. EAT, or earnings available to equity shareholders. No, it was the EBT, 11,52,000, because there are taxes, minus taxes at the rate of 40%. 11,52,000 multiplied by 40%, which is 4,60,800. So earning after tax or earnings available to equity shareholders will be 11,52,000 minus 4,60,800, which is 6,91,200. 6,91,000. All right. What will be the value of? Let me also write down A Limited with the taxes. What was EBIT in A Limited? 18 lakhs. What was interest? 0. What was EBT? 18 lakhs. What was taxes? Taxes will be 7,20,000. This will be 10,80,000. What was KO? %18. No, KO will change because there are taxes. Please understand that debt is tax deductible. This 12% is a tax deductible. So KO will change. But let me do this. EAT, I am finding out value of a firm. What is KO over here is 18%. Here KO will change because the value of firm will change. Value of a firm, if the firm was A Limited, which is unlevered, the answer will be 10,80,000 divided by 18%, which is 60 lakhs. What will be value of levered firm with the taxes? What will be value of levered firm? See, here K is going to remain 18%, right? It does not changes. KO is 18%. Here there are no debts, so K is going to remain 18%. But the value of firm in case of levered, because it is with taxes, what will be the value of firm is 60 lakhs plus debt into tax rate. What is debt? 54 lakhs. What is this? 54 lakhs debentures of 12%. Multiplied by tax rate, which is 40%. It is not 1 minus T, it is directly T. So what should be the value of levered firm? Sir, B Limited and A Limited, the value will not be same. No, it will be same if there are no taxes. It will not be same if there are taxes. It is clearly written. Value of levered firm will be higher. What will be the answer? 54 lakh into 40% plus 60 lakhs, which is 81,60,000. Right? This is value of the firm. What will be value of debt? 54 lakhs. What will be value of equity? Value of equity will be 81,60,000 minus 54 lakhs. 27,60,000. Value of equity. What will be KE? Earnings available to equity shareholders 6,91,200 divided by value of equity 27,60,000. 6,91,200 divided by 27,60,000, which is 25.04. KE of levered firm with taxes is equal to KE with of levered firm without taxes. So the formula does not change if there are taxes, if there are no taxes. Summarizing, are you getting it? This formulas remain same. If there are taxes, if there are no taxes, the formula of this KE of levered firm as per remains same, because we have understood KE does not change with the taxes. Taxes 0, tax is there, it does not make any difference. The value of equity might change, but the required rate of return of equity shareholders will not change because the risk has remained constant. So it will remain 25.04, and this is also 25.04. Let me summarize What it says? Value of levered firm is equal to value of unlevered firm plus debt into tax rate, and KE. So now, sir, if there are no taxes, then this answer will be 0 and value of levered firm will be equal to value of unlevered firm. So no need to learn that two different aspects. KE will be KO plus debt upon equity upon KO minus KD. These two formulas we will use when we are solving questions of Modi-Giuliani-Miller approach. We can easily use these two formulas. Let us summarize everything that we have done in this lecture. This 2 hours lecture, we have done n numbers of things. We have done EBIT, EPS and financial break-even point, but that portion was of previous lecture, so let us skip that. What we have done in current lecture is, first we have learned that value of equity, value of debt and value of company. Value of equity is equal to what earnings are there for equity shareholders, earnings available to equity shareholders, divided by KE. Because we are valuing equity, we should take required rate of return of equity. Value of debt is nothing but interest divided by KD. Now, sir, how to find out KE? We can just change the side, right? KE is earnings available to equity shareholders divided by value of equity. KD is interest divided by value of debt. Value of firm is EBIT, because EBIT belongs to both, upon KO, or KO is EBIT upon value of firm. Also, value of firm is equal to value of debt plus value of equity. Then we did 3 approaches. Net income approach. Exactly same as trading on equity or leverage effect. Then comes net operating income approach. Relevance or irrelevance? Irrelevance approach. What it says? As you increase the debt proportion in capital structure, your cost on one hand should reduce, but because risk will increase, your cost on other hand will increase, which will compensate each other, and KO and value of firm will remain same. Why cost should decrease? What is the reason? KE is always greater than KD. Why cost will increase? Because KE will increase. And ultimately KO and value of firm will remain same. Modigliani Miller says the same what he has said, but he also explains arbitrage approach, where he says that if you are in a levered firm, you should take all your equity shares, create personal leverage, and go to unlevered firm, and ultimately your earnings will increase. Also, he takes same net operating income approach and proves that value of levered firm is value of unlevered firm plus debt into tax rate. Also, KE is equal to KO plus debt upon equity, KO minus K. All this formula, all these things will be important when we solve questions of capital structure.